Hello and welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at The Australian. And today we are going to be talking about new changes in property happening right before our eyes. China buyers are back in the market, coming into the top end, Sydney and Melbourne, and also we see on the Gold Coast, sometimes they are paying cash. They are a swing factor in the market. We're going to take a look at that. We're also going to take a look at reports that domestic property investors are actually certainly quitting in Victoria. We're going to try and find out why and to what extent is that an issue for all investors in the market. My guest today is Pete Wargent of Alan Wargent Buyers. They operate out of the Sunshine Coast. Hi, Pete. How are you?
I'm really good, James. Great to be back on the show.
Nice to have you on again. Tell me, the first thing I want to know is about China buyers. Just this week, I'm starting to see stories of China buyers coming back into the market, particularly up in the zone where you are. Yeah, I know you're based on the Sunshine Coast and that area, Brisbane, Gold Coast, of course, a traditional favourite. There's always a debate about this. Actually, the real debate that matters to investors is how important are they? That is, do they really swing the market? I'm sure it's a positive on the demand side when they come in, but have you seen a rebound in any measurable fashion?
Yes, expats and foreign buyers are definitely coming back into the market, and I think that's driven by record low vacancy rates, a certain amount of FOMO, but also the domestic property market in China has not been very healthy. So I guess that would have moved some of the demand overseas. And, the official numbers show about 10% of new builds going to foreign buyers and about 4% of established properties, which is a 5.5-year high. But it's always a bit nebulous with these figures. How well are they capturing the flows of capital? And we do know the pathways for foreign capital to come back into the country have certainly opened up again with the return of international students, the reopening of the international borders. And certainly the July surveys, they take these surveys regularly, and the top 10 markets for Chinese buyers, Australia's number one, ahead of Canada, UK, US, everywhere.
Is that right?
It's happening.
Is that re-emerged, or has that been consistent?
It's re-emerged. I mean, we really saw a hiatus, I suppose, through the pandemic because we had international borders were closed, international students largely were absent. But now we're seeing, we've also got more millionaire migrants than any other country in the world, and they're mainly from China and India. So, yeah, and look, in terms of locations, yes, Queensland, we've seen some of it. I think this time around, though, there's a lot more capital going into the premium end of the market. So, Toorak got some media this week, I saw, but Sydney's eastern suburbs. So it's not just at the sort of new apartment level this time around. I think there's capital going into the more premium end of the market.
Interesting. And if they are, I presume they're capable of buying cash or at least having a very, very large deposit. When they come in to the market, not so much do they scare other people off, but I presume there's a part where people say, oof, I'm not going up against a tycoon. I'm thinking of commercial property. I used to go to commercial property auctions once upon a time, a million years ago when I was a baby property reporter. And there was some funds that were really strong, at the time, say A&P or whatever. And there would be a building for sale on the street. It'd be a block on Collins Street or whatever, 25 million at the time. And I remember being at an auction and somebody, and someone from A&P would put up their hand and everyone would say, I'm out. I'm not going against them. Does that happen with China buyers?
It certainly happened in the last cycle. If you think back 7 or 8 years ago, and you turn up to an auction and you'd hear people say, there's hot foreign money coming into the market. And as you pointed out, how much does it make a difference? Well, it does, because property prices are moved at the margin. So even though it might only be sort of 4% of established properties on the official numbers, but if you've got a marginal buyer that's prepared to pay more than the next person, of course that moves the needle. So look, it's definitely a factor, and it may be something that needs looking at again.
Okay, so you're on your estimation, basically they are back. Australia is the number one overseas sort of target market from China buyers, and they're looking at the premium end, they're looking at the apartment end. It would seem to me that WA is actually the bargain I won't say bargain basement, but bargain territory in the market. Any sign of them going in there?
I don't follow the Western Australian market as closely. I mean, traditionally, most Chinese money has gone to Sydney and Melbourne, and then Southeast Queensland is a third destination. So it would be less common typically, but it'd be interesting to see this time around because actually, yes, Perth has been the cheapest capital city in the country for detached house prices, and vacancy rates are under 0.5%. So it's extremely tight over there. So it would make sense from an investment perspective, but whether or not that's happening, less clear to me.
Okay, interesting. Now, just looking at it, a couple of other things I wanted to ask you. So the China buyers really, to some extent, they are have their own imperatives, and what's going on with interest rates in our market doesn't make an awful lot of difference to them, I expect. But for most investors, we're told there's a sense we're at the top of the cycle. There's a sense we're at the top of the cycle for a considerable period of time. We've been told this for more or less a year. The RBA keeps lifting rates. Do you think, I'm not asking you, I couldn't expect you to know, but do you think your buyers, because you're helping buyers, you're going in with buyers, you're assisting buyers, do you think your buyers are of the opinion that they'll be paying lower rates in a year's time?
I think, yes, people are looking across to the other side. Now, I think if you look globally, markets are expecting for the US, for the UK, for the Eurozone, that we'll see interest rates starting to come down next year. I think, though, if you look at Australia, we're a bit further behind on that journey, and higher for longer is probably, well, market pricing suggests exactly that. So, yeah, look, it's I think people are generally holding on, but I do think there are more investors leaving the market than entering at the moment. So credit growth to investors overall is very modest. And of course, this isn't helping the rental crisis with record low vacancy rates across the capital cities and higher interest rates. That's the main driver. There's a number of factors, but that's the big one.
Yeah, that's the big one. So it seems to me you're saying not to be waiting for interest rates to drop anytime soon.
Oh, well, look, it's I guess the oldest cliche in real estate. There's never been a better time to buy. That's normally what property buying companies would say. I think
That's what they always say, Pete.
yeah, that's right. Well, I think if you look at the factors, there's a whole load of green ticks, and I suppose at the moment you've got all-time high immigration and population growth. We've had a huge surge in building and construction costs, which is underpinning the value of new builds. We've got the lowest rental vacancy rates on record. We've got rents rising at a double-digit pace, even decent nominal wages growth. Those are all green ticks. We've got one in the other box, obviously, which is interest rates. But I would say, I mean, usually property investment works best as a 10 to 20 year plus decision. So logically, if you're an investor over that kind of time frame, you're probably going to experience a recession or two. You'll get low inflation, high inflation. You'll have undersupply and oversupply, which we have seen over the past decade, and you'll get low mortgage rates and high mortgage rates. So at the moment, that's the one big factor which is pushing people out of the market as investors. There's a few others. We've seen land tax increases proposed in some parts of the country, and there's definitely a lot of uncertainty, and there's been some government intervention in terms of tenancy rights. But it's been a robust market to sell into, and I think some baby boomers in particular have been cashing in for their retirement.
So this it's profit taking. Some of this investor quitting is profit taking. Still, though, if the market was wonderful, they wouldn't quit, would they?
Yes, I mean, I think if you look at what has been sold, often it's apartments. We've seen in places like inner Melbourne, where, I mean, the proportion of investor sales there as a share of new listings is running at well over 50% and miles above the 5-year average. Sydney City, the same. So I think it's often the worst performing properties in a portfolio that are being offloaded. So the quality of listings isn't always that high. But yes, some investors are bailing. And this isn't great because we've got a rental crisis at the moment.
What about what they might do next? Because the REI, I talked to the REIV, Real Estate Institute of Victoria, in recent days, and they're saying that investors are fleeing. Now, they would talk like that. That they're saying investors are fleeing, and understandably they would talk like that because there's been 2 rounds of new property taxes in the state of Victoria, and they pay the same interest rates as everybody else, but more or less operate in the same market as everybody else. By that I mean the vacancy rate is similar, the interest rates are similar, so there's broad similarities. What I want to ask you is, do you think, or do you see, or perceive, or expect any flow of investors out of Victoria into Queensland, which there's a historical precedent for that in the past?
Yes, a little bit. I think if you look at the fundamentals, Victoria has the highest expected population growth over the next 10, 20 years. So maybe not too much change there. But yeah, I mean, we're Brisbane based, and we do get quite a lot of people relocating from Victoria or investing their capital that way. So yeah, the land tax proposals will have put some people off, tenancy rights. Yeah, so there's a little bit of a flow, but I think possibly overall, I think a lot of people in Melbourne are quite happy to stay invested in Victoria. So there's a lot of demand for housing down there.
Yes, yeah, okay. It's interesting. Yes, there is definitely, as you say, that's an interesting observation that you're noting and you're aware of the fact, like listeners, it's worth considering this, that there is a sell-off, investor sell-off, to some extent around the markets, particularly in Victoria, where the numbers are higher than anywhere else. But as Pete is saying, watch the nature of that property that's been sold off. It's not exactly trophy homes. It's what might be conventional investment property that may not actually be of the best grade. Okay, one last thing, Pete, before we go to questions. In the housing market, which everybody's interested in, we had a sense there was supposed to be a mortgage cliff. I'm not denying there was a mortgage cliff, but there was supposed to be a big fallout from the mortgage cliff, where people wouldn't be able to pay their mortgages when they went off, when their fixed rate, their COVID era fixed rates rolled over to today's rates. We just had the bank results. They keep coming. ANZ, CBA, all 4 now have reported. Combank is only a trading report, but the others are full results. And the point I'm making is that there's absolutely no signal of raised stress levels. Delinquencies are zilch, really. That's what the banks are saying. What's going on?
Yes. So, yes, if you look at Moody's figures, delinquencies were rising through the middle of this year, but they're not back yet to the pandemic highs. And as you said, the major banks have all reported very benign 90-plus day delinquencies. Well, I mean, generally, the main causes of mortgage arrears and defaults are very high interest rates, high rates of unemployment, or in some cases, rental vacancies or natural disasters. But at the moment, we've still got full employment and we've got all-time low rental vacancy rates. So naturally, delinquencies are low, but we would probably expect from here that unemployment and underemployment will rise. Plus, we've seen the fastest increase in mortgage rates in a generation. So yes, delinquencies are low, but we can't necessarily rest easy. Now, the ANU does run a financial stress indicator. Ben Phillips, big fan of his down there. And probably by the end of this year, you'd say with the Melbourne Cup Day hike, about half of mortgaged households will be under what they would determine to be financial stress, which is basically at least 30% of your income to service loans. And I mean, clearly the share of household incomes going to mortgages has jumped right up since 2019, when it was about 20%. Well, now it's going to be nearer to 30. So I don't think we can rest easy, but at the moment anyway, you would expect that would hit retail sales more than mortgage arrears. But if we get a rise in unemployment, it could change.
Yeah. So they're paying the mortgage basically and cutting back in other areas. And Pete, just explain to listeners what you do. We should have explained properly. Alan Wargent Advisory, operating in Queensland. You advise buyers or buyers and sellers?
Yeah, so both. We predominantly are a property buyers agency, and we're licensed in New South Wales and Queensland. So yes, we advise people on property strategy, and for people looking to buy property, we offer an end-to-end service. So that's our bread and butter, and it's a growing industry.
It is a growing industry. You're not the first mortgage buyer advocate I've had on. In fact, I always like to talk to you guys because you're in the thick of things, but you're not an agent, or you're not acting as agents. So I just find that a slightly different perspective. And I find it basically a refreshing view. Okay, first question from Chris. Love the show, long-time listener, first-time caller. Okay, Chris, the RBA has been saying for a while that inflation is expected to return within the 2 to 3% target sometime in 2025. Given inflation went above target in early 22, this could mean 4 years of excess inflation. Would the RBA be better off overshooting the target range on the way down for a period of time rather than returning to the band and staying there? It's a really good question, Chris, and there is probably a small army squadron of economists who would say they are overdoing it already, and that the most recent rate hike in particular was debatable. So that may well be what occurs, whether it's their plan obviously would be to try and get perfectly within the range and get inflation down exactly to where they want it. But it's not a precise art, and I think anything could happen, really. And as Pete said at the start, we're kind of late to the party. We were late to the party in our rates pressures. Then we were quite late in lifting rates compared to, say, the US. And now we are still lifting rates when perhaps others have stopped or nearly stopped. Would that be your take on it, Pete, or would you have a different view?
Well, yes, because Australia's international borders stayed closed for so long. So we had a long period there where there was severe labour shortages, we had supply chain issues. So that is a big part of it. And I guess, look, in terms of Chris's question there, obviously there's the inflation target, which seeks to keep inflation in the economy at 2 to 3% on average over the medium term. But to build credibility, the goal should be to return inflation towards the midpoint of the target range. Now, people do worry about an asymmetric inflation target, which is essentially what Chris is talking about. But if you recall, inflation was actually below target for half a decade, from 2014 until 2020.
Right.
And at the time,
seems like a long time ago,
doesn't it? Yeah. I mean, and in fact, as recently as 2 years ago, some economists wanted to reduce the inflation target to a 1 to 3% range to recognize, I guess, the structural changes in our economy over the 3 decades since inflation targeting was adopted. Also, to bring Australia in line with some other developed economies with 2% targets. But yeah, if you think back to that 2014 to 2020 period, at the time there was a concern that cutting interest rates too low could lead to a build-up of household debt and therefore financial stability risks. I think a key global lesson from the pandemic should be that fiscal policy can be much swifter and more effective at stimulating demand. So in plain English, if you give people money, they'll spend it. Or the same is obviously true of home building grants. So, and I think, yeah, for 5 years,
JobKeeper.
We had a tug of war where the government didn't want to help with the RBA with fiscal stimulus. So look, if that situation arises again, whereby the cash rate falls low, well, hopefully the federal government can step in and be more proactive. But anyway, in the short term, the RBA needs to be looking to bring inflation into the target range. Otherwise, there may be a credibility issue.
There may be further credibility issues, we might say. Okay, a question from Kevin. This is an interesting question. How much lenders' mortgage insurance is paid by borrowers in Australia compared to how much is ever paid out? One would think, with property values mostly rising and default rates being exceptionally low, there is very little lenders' mortgage insurance ever redeemed. Who wins here? Who's pocketing the difference? I don't know how to get the answer. Yeah, okay. I expect, first of all, Kevin's right. I imagine it's quite a lucrative, you would think it's a lucrative business, lenders' mortgage insurance. The people who are pocketing anything would have to be the providers, Kevin. People like QBE, big player, Genworth. QBE is listed, of course. But of course, it's only one line of their business. And so the overall profit figure wouldn't necessarily reflect good times in one subsidiary line of business. The other thing is that even the banks, I think some arms of Westpac are in it through offshoots, St. George, etc. So they would be the main players. But have you ever looked at that, Pete?
Well, yes. I mean, and I guess Kevin's absolutely right. In a normal year, in inverted commas, it's going to be a lucrative business. And of course, insurance companies need to make sure they charge the right premiums, accurately pricing risk every time they write a policy. However, unforeseen things can happen and insurers can lose money. That's the nature of the industry. But yes, over the long run, a well-run insurance company can be a great business because they're constantly reevaluating risks. But in insurance, you do get these surprises. Pandemics, obviously, as we've seen, but big recessions. In Australia, we might have bushfires and floods and so on. So yes, as you mentioned, the biggest mortgage insurer in Australia was Genworth Mortgage Insurance, now rebranded as Helia Group. And yes, in a good year, you might write, let's say, 500 million of gross premium, and delinquency rates are usually very low, about 0.5% or thereabouts. And the loss rates in a normal year would usually be very low. But every so often, in fact, including in 2020, something nasty happens. And then you can end up with losses and write-downs, or you get something like the Banking Royal Commission, where the turnover in the market just drops away. So look, investors and shareholders know the cycle or cyclical risks associated with monoline mortgage insurers, particularly since the GFC. So stock prices tend to trade at reasonably modest multiples, and the income streams can be decent enough. And I guess if you follow back the Genworth story, stock price got absolutely slammed in 2020 because there was so much uncertainty. The price was from $4 to $1.70 or so. But it's rebounded close to $4 today. So I guess you would argue that the robust capital adequacy and the capital ratio has been sensibly managed through the cycle, and the potential for a pandemic crisis was well averted.
So no such thing as a sure thing, even in lender's mortgage insurance in Australia. Just to digress for a moment, I saw something very interesting the other day about insurance generally, home insurance that is. And in Australia, the big issue is actually flood. You would think fire is so dramatic, but in terms of dollars on the table in insurance, the big issue is flood. And of course, the floods are often in urban areas. Brisbane, for instance.
Something we know a lot about in Queensland, unfortunately. Yes.
Yeah, absolutely. Yeah. And it's a part of the business I never quite realised before. Okay, Claire with a CLAIRE. Quick question about the hoops and handstands banks make us go through to earn bonus interest. Is it legal? Yeah, it's legal. It's legal, Claire. Who regulates this? ASIC, I would think, Claire. And how can we argue against it? Oh, back to that in a moment. So Claire says, it seems farcical to me that I need to make a minimum deposit every month but don't need to grow my balance. It seems a plot to try and avoid paying the bonus interest by making it as complicated as possible. Yes, Claire, I completely agree with you. I've written about this more than once. Whatever happened to the simple business of putting money in the bank and getting a good rate of interest? You have to tunnel through endless variations where they want you to do this and to do that and deposit so much a month and keep it over a certain point and all that. It's not, it's entirely legal. I think it's unfair. I think it's misleading. I completely agree with you, Claire. What do you think, Pete?
Yes, well, saving money isn't easy right now because of the cost of living pressures. But for consumers who are managing to save, well, some of the banks are offering the highest interest rates on savings accounts that we've seen in years. Now, there was an investigation.
Yes, but when you look at those rates, they're you must behave in certain ways. I just want a good rate. Put it in and forget about it.
Right. So there was an investigation kicked off earlier this year by the ACCC, the Retail Deposits Inquiry. Now, the final report isn't out yet. But
yes, I should have said ACCC, by the way, and not ASIC. Yes.
Yes, and some of the banks have delivered interest rates increases on some savings accounts. And yes, there's all kinds of different competing pressures that affect the deposit rates, like how much desire is there for new business, what the competitors are doing with savings rates, the RBA increases, margins, interest margins, and so on. I guess, as you said, the bonus savings account often come with all these strict conditions attached, like no withdrawals or minimum monthly deposit. Sometimes there's a time requirement or a time limit. So you've got to be very mindful of all these strings. So yeah, the banks certainly don't make it easy, and I think it does need to be looked at further because there's stacks of introductory rates that just expire after a few months, and people shouldn't have to just keep moving around to get a decent rate. And as Claire rightly pointed out, there's many hoops to jump through. So
There's
yes,
many
I
hoops,
agree.
and it's all about getting they're all chasing new borrowers, and it's the old thing of the loyalty tax kicks in. There is absolutely no attention on someone who stays for a while, and if you look, they're all front loaded. Claire. So I see where you're coming from. I have looked at it. It's interesting that Pete made the point that the Australian Competition and Consumer Commission, the ACCC, were also looking at it during this year. It's all allowed, but I don't think it should. It's not that it shouldn't be allowed. The information should be presented in very clear streams, and that is not being done at the moment. In fact, as Claire says, it's as complicated as possible. And then the separate issue as to how much the actual rate is. My accountant always tells me, every I'm doing my tax at the moment, he tells me, listen, James, make sure you put in the interest you received from this and that. And I looked at my interest from my 3 NAB accounts. No, my two SGB, St. George Bank accounts, and I added up the interest in the two accounts. One was 0 and the other was 0.55 cents. 55 cents, folks, interest gained. Yeah, make sure the taxman doesn't miss that. Okay, back in a moment with a final question from Andrew. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, wealth editor at The Australian, and I'm talking to Pete Wargent, who has been on the show before. Always good, always interesting, and a very wide view of the property market. He operates out of Noosa. Well, the last guest we had on from Noosa was Tim Lawless from CoreLogic, who was complaining it was a windy day in Noosa. You have it so tough up there. I don't know how you guys survive. Really, Pete? What's it like today?
Tim's a lovely guy. It was actually Tim Lawless who convinced me to move to Noosa. So this was at a Business Insider event some years back, and I was living in Brisbane at the time. Yeah, lovely guy, Tim, and he's obviously a top analyst as well. So
he is a top analyst. And what's your? I'm looking out the window over the spire, over the tension net on the Melbourne Arts Centre. And there are masses of grey clouds, and we had a shower this morning. What's outside your window?
It's always a glorious day in Noosa. You should know that, James. So, yes, very sunny day as usual.
Is it? Of course it is. Of course it is. Okay, final question from Andrew. Do you think it would be a good balance of risk versus market enabling for APRA, that is the prudential regulator, folks, to let financial institutions assess home loans with a buffer pegged to the 10-year Australian bond? For instance, if the bond is 5% and the agreed serviceability buffer is 3%, then the bank would run the figures against an 8% rate, as this would naturally increase and decrease given market conditions. It may allow the flexibility that both banks and borrowers need. Andrew, I think they more or less do that. I mean, it may not be precisely that, but this is what this mortgage service buffer is. It's 3%. And it's on top of the cash rate. Cash rate's 4%, so your buffer is 7%, roughly. Is that? Have I got that right, Pete? Is that basically how they do it?
So the 3 percentage points lending assessment buffer is in place. So it's not against the cash rate; it's against your actual mortgage rate.
I'm sorry, it's against your actual. Well, it'll be underpinned by the cash rate, but it's against your actual mortgage, whatever the price was on the window. So if the mortgage is 6.5%. To you, the bank assesses you on 9.5%.
Yes, and I agree with what Andrew's saying, which
is
basically a counter-cyclical policy could make sense. So I would say, broadly speaking, at the moment, I think a 2.5 percentage points lending assessment buffer would make a lot more sense than what we've got, which is 3 percentage points.
Then 3.
Yeah, I mean,
you think it's too high?
Well, of course, we could get a dozen more interest rate hikes and more. It's not impossible, but normally, in that kind of environment, you'll be getting an increase in nominal incomes as well. So I think look, the 3 percentage points buffer made sense when the cash rate target was stuck at the 0 lower bound. But now the lending assessment buffer is too high. It's shutting borrowers out of the market, and paradoxically, it's contributing to financial stability risks rather than reducing them. So it made sense, but probably not now.
Okay, good point. Yes, yeah. All right. Very, very good point. That should be reviewed. I presume it is under constant review, but I know that more recently when APRA was asked about that, they said, no, we're not. It's fine for the moment. They reaffirmed their view that 3% was the correct buffer that we all must adhere to and submit to when we go in for a loan. So remember that, folks. If the mortgage is 6.5, as I say, you may not get that 6.5 because the bank must assess you on the number plus 3, which is 9.5. See how it works. Okay. Well, thank you, Pete. That was great. Great to talk to you again.
Always a pleasure. Thanks, James.
Nice to know it's a beautiful day in Noosa. That was Pete Wargent from the Buyers, Alan Wargent Buyers Group, an advisory group operating in both New South Wales and Queensland, as he says. Thank you, everybody, for listening to today's episode of The Money Puzzle. Keep those questions, comments, complaints, observations rolling. The email is themoneypuzzle@theaustralian.com.au. Talk to you soon.